The foreign exchange market is by far the world's biggest financial market. It has a daily volume of more than 5.3 trillion US dollars. If you would take all equity markets worldwide, the resulting volume would just be a fraction of that number. It's also well known that more than 90% of market participants lose. Since this money is not gone, but just changes hands, the question is, where's the money? Regarding the Forex market, there are different beliefs which are very popular, and these tend to be completely incorrect. People think that nobody can actually influence a market price, or they think that the price is a result of demand and supply, like in other markets, or academics believe that the market would be random. Each of these beliefs is completely incorrect. It is a good idea to look at an example from the hedge fund industry. FX Concepts under John Taylor used to be the world's most successful hedge fund specialized in foreign exchange. At one point in time, they had over $14 billion assets under management. Over decades, they did very well. However, in 2013, the company went bankrupt. So the question is, what happened here? They had a team of over 20 specialized analysts. They all worked on different systems, on backtests, on testing, etc. However, something may have fundamentally changed. The answer is in front of our eyes. The truth is that the market as such changed. And if you do your research and you put one and one together, you will realize what's going on. If you, for example, Google for the term market manipulation, you will get hundreds of different results in different cases. And here you have the official definition. The Forex scandal is a financial scandal that involves the revelation and subsequent investigation that banks colluded for at least a decade to manipulate exchange rates for their own financial gain. Here you can see a collection of different news articles regarding this topic. Global banks admit guilt in Forex probe, fined nearly $6 billion US. 4 major banks pleaded guilty on Wednesday to trying to manipulate foreign exchange rates, and with 2 others were fined nearly $6 billion in another settlement. Or, first arrested Forex scandal, former RBS trader held on suspicion of rigging 3.5 trillion foreign exchange market. Former trader at RBS becomes first to be arrested in Forex scandal. Or, big banks are fined $4.25 billion US in an inquiry into currency rigging. Germany's financial watchdog worried over scale of Forex manipulation. And here you even have a diagram which shows the name of banks involved as well as the names of individual traders and how these guys communicated in a cartel chat room. When you look at the explanation from the point of view of the banks, you find texts like these. Conduct by certain individuals has fallen short of the firm's expectations. So basically the accused banks say, well, individual traders did this, it's not our firm's policy, and then those traders get fired, but the truth is they get replaced, and most likely this game is continued. And if you're still skeptical, this is an official text by the US Department of Justice. This is the link. 5 major banks have agreed to plead guilty to felony charges, have agreed to plead guilty to conspiring to manipulate the price of US dollars and euros exchanged in the foreign exchange spot market. The banks have agreed to pay criminal fines totaling more than $2.5 billion. The penalty these banks will now pay is fitting, considering the long-running and egregious nature of their anti-competitive conduct. The charged conspiracy fixed the US dollar-euro exchange rate, affecting currencies that are at the heart of international commerce and undermining the integrity and the competitiveness of foreign currency exchange markets, which account for hundreds of billions of dollars worth of transactions every day. It's a good idea to look at who the players in the foreign exchange market actually are. On the one hand, we have big corporations who intervene in the forex market because they may produce products in one country but sell them in another country or get paid in a different currency, so they need to place orders in the market. And obviously, in order to hedge the currency risk, they will also go into the foreign exchange market and balance certain positions and exposures they have. However, overall, you have all kinds of players. You also have governments, central banks, mutual funds, hedge funds, also private traders, etc. But the reality is you could simply distinguish into two different groups. On the one hand, you have the smart money, and on the other hand, you have the so-called dumb money. The dumb money is not stupid, but just has less information than the smart money. On top of that, the smart money also has price-making abilities, so they can actually determine where the price will move next. It's also important to understand that on the dumb money side, where the biggest group is most likely composed of corporations hedging themselves, those entities are not necessarily intervening in the market to make a profit or to speculate. They simply want to hedge themselves against any currency fluctuations that would affect their balance sheet. So in a way, there is no big conflict of interest there either. However, it's also clear that on the smart money side, we have big funds who use algorithmic means in order to affect the currency prices. The reality is that price-making entities collude together in form of a cartel. They will not compete against each other. Those smart money algorithmic funds are most likely connected to investment banks. However, they are separate entities. Otherwise, the massive profits they generate would be seen on the balance sheet of the banks, which is not the case. It's also quite obvious how this works. You may have heard about dark pools. Dark pools are parallel markets where only these kind of players have access to. Rather than trading against each other, those players will cooperate and be on the same side of the trade, while the majority of market participants, the dumb money traders, are on the other side of the trade. And those players will, of course, influence the market price, and they do so via dark pools and other tools. If you, on the dumb money side, have access to an order book, apart from the fact that the Forex market is decentralized, you will only see a small fraction of the actual order flow. A big part of the order flow, which also influences the market price day by day, is transacted via the dark pool system. And no dumb money player has access to that. So in a way, the financial market is like an unfair poker game. The smart money algo funds work together. They can influence the market price. So they can see the cards of all other players, where their positions are, where their stops are, but they can also decide what the next card on the table will be. However, things get even more complicated, because on top of that market maker driven manipulation of the actual market price, we have another layer of manipulation that is implemented by many brokers, specifically OTC over-the-counter brokers, who tend to be active in the retail market. It is well known that there is a whole list of different tricks many of those companies use in order to make themselves win and their clients lose. We have an example here, an article that broker has biked thousands of customers out of hundreds of millions of dollars using deceptive and unfair trade practices, including falsely portraying its Forex trading platform as a fair, transparent and true foreign exchange, when instead it's a rigged game. There is a whole list of different things OTC brokers tend to do. And unfortunately, this is not a peripheral phenomena, but it's a very, very common practice. For example, the broker may manipulate the spread difference between bids and ask prices against you. Or they may manipulate the slippage, the price of the order which got filled. So there's a small time lag when you click the button, and overall this slippage, the difference in the price you saw and the price you get, should balance itself out, because sometimes it goes against you, sometimes it goes in your favor. However, some brokers manipulate the slippage so that it always goes against you and in their favor. Or the broker may outright move the price against you to your stop, even though the real market price never touched that level. This is a very extreme form of manipulation, which is highly illegal. Or the broker may suddenly make your platform freeze in very important moments, such as news announcements, so that you cannot change orders or place orders in the market, but your whole platform is simply frozen and not able to trade at all. I recently even have an example of a friend of mine who observed that the broker changed a winning trade on his account into a losing trade. So you need to keep track how your book looks like and whether all trades were conducted correctly. So unfortunately, we have a whole range of different strategies those brokers follow to make sure that they win and you lose, because market-making brokers are on the other side of the trade. So they do really trade against their clients, and some of these strategies may be in the legal gray zone, others are, however, highly illegal. And now I'll show some cases where clients complained and the regulator fined the broker. However, these are just individual cases. Overall, unfortunately, it's common practice that many of the popular brokers follow those kind of strategies and trade against their clients. It is true. Now here, you may have heard about that software, the so-called virtual dealer plugin. This is a software which was designed for those brokers to manipulate the price against the clients. And look what it says. Processing of pending order activations, stops, triggering, and stop outs. So there are different tools they have, but this is one of them. And here you have a thread in a forum where somebody who worked for such a broker tells what's going on. Yeah? I've been working for various brokers in the past in various positions, gaining lots and lots of inside knowledge of the inner kitchen. I've seen people who put millions and ones who put their last $25 in their accounts, only to lose everything in an unfair fight. And here you see a screenshot showing how the virtual plugin works, how the settings are, and this is highly, highly questionable. It's a pity that regulators are not stricter with these kind of companies. So overall, the reality is that the foreign exchange market is to 100% manipulated. This goes against the basic tenets of many people, including academics, who think that the market is random, that nobody can change the price, that it's a fair game in a way. This is completely incorrect. It is an unfair, rigged game. And much of those manipulation activities, many of these are highly illegal, no questions about it. However, I also would like to say one thing, that sometimes the line between the activity of market making and price manipulation can be quite thin, because as a matter of fact, if a market maker allows you to decide whether you buy or sell, when you do it, how much you buy or you sell, and the market maker has the opposite position straight away, it's easy to see that if they just earn the spread, but in return they have to bear the full price risk, this is not a good business model. So it's kind of common sense that they also have some control over where prices go in the end. As explained, dark pools most likely play an important role in that process, and while markets in general get more and more democratized, which is a good thing, there are still markets that are not accessible to retail traders, not even to professional traders. And as explained before, one should distinguish between those different players and the different types of manipulation. Between the manipulation of the actual price conducted by the market makers and then the price manipulation implemented by different brokers. Unfortunately, this is not a peripheral phenomenon, but this represents the activities of many popular brokers those which have a very nice logo and a nice website and try hard to create some kind of trust to the clients, but to actually, at the end of the day, trade against those clients. There are also ECN or DMA brokers, direct market access brokers, who may charge higher commissions. However, in return, you may get a better price feed and your chances of winning are better than compared to a broker where you may have a winning strategy, but because of the broker's actions, you will lose at the end of the day. It is fascinating that despite the dump money can do all kinds of things. They can buy, they can sell, they can go long, can go short, they can follow trend following strategies or reversal strategies or breakout strategies or scalping strategies. The smart money algo funds who collude make sure that those players don't have a chance to win. And they do this by following certain concepts every single day, which will be explained later. Furthermore, as explained, one should distinguish between the different layers of manipulation. On the one hand, you have the manipulation of the price by the market makers. On the other hand, you have manipulation done by different brokers who are not ECN or DMA brokers, but actually do manipulate the price against the clients because they have the other side of the trade. Experienced traders know that this phenomenon occurs on a regular basis. Stop hunting. If you look at the market price, you will see that eventually there are certain levels the price just wants to touch. And the reason for that is the following. If you enter a trade into the Forex market, you need to also add a stop order because otherwise your downside is unlimited. However, as you can imagine, those stop orders of all kinds of traders tend to accumulate at certain levels. And those levels are the targets for the market making algos. They want to push the price there so that they win and the rest loses. So these stop clouds are a magnet for the price. When you have a squawk service, you will realize that even the squawk will tell you now and then, at this price level, at that price level, we see an accumulation of stop orders. And this is what I talked about earlier. It's relevant how many stops are placed at those levels and what the density and distribution of these stops is. If you're an experienced trader, you will know that the market sometimes does aggressive moves in one direction, or exaggerated moves, sometimes in the context of news announcements, and most of the time these moves are related to stop hunting. This belief that you should place your stop below the last low if you're long, or above the last high if you're short, is very wrong, because especially in the short term, these levels tend to be the levels that are hunted by the algo, by the smart money funds, in order to take out all of those stop levels, and in order to make sure that dumb money traders cannot place good risk-reward trades. It took me several years to figure out how these principles work in detail. But at the end of the day, it's quite obvious how the mechanics of this manipulation work. At the end of the day, the dumb money traders only have a few choices. Either they close their position at a loss, or they increase the position, which makes the problem worse in most cases. They get stopped out. If they pull away their stops, they will get stopped out eventually at a bigger loss. If they do not use any stops, they will get a margin call and their accounts can be even blown out completely. It has to be stated that, of course, there is a certain tolerance. Within a certain margin, some dumb money players are allowed to win a little, otherwise the price could never move. News announcements play an important role in the foreign exchange market. Many aggressive moves or big moves are a result of economic announcements, such as inflation, GDP, unemployment, etc. And as you can imagine, those moves depend on the dumb money bias. If you make an historic analysis, you will see that sometimes the price move as a result of news announcements follows economic logic, but at other times it completely disregards economic logic. For example, US unemployment may be published, and the unemployment is higher than expected. So the dollar should drop in value and the euro dollar should increase. However, often you see that the opposite happens. The unemployment is higher in the US, but suddenly the euro dollar goes down. How can this be? This defies any economic logic. Well, the answer is, as you can imagine, it's more important for the smart money algo funds to take out the stops of the dumb money. So they are even willing to disregard economic logic at times. However, in general, they try to maintain plausibility. So if they can, they try to move the price in a way that makes it look economically feasible and that there is some kind of logic which is respected. But sometimes, if the degree of boldness is high, they may be willing to completely disregard that. If, for example, there's a big stop cloud on the other side and they want to take it out. Sometimes you can observe that the smart money algos move the price slightly in the economically correct direction, but then take back that move all the way. So they always try to maintain plausibility to make things look logical. This is probably a good example to explain what I mean. So on this date, on the 23rd of July 2014, the New Zealand Central Bank was supposed to publish their new interest rate changes. And if you did your homework, you did your research, you could observe that historically the bank tended to increase the rates by doing that over 3-4 different steps. So 25 basis points, 25, 25. In that case, we already had 2 or 3. So it was likely they would increase it again. Secondly, there was a speech by the central bank president on the internet where he indicated that he intends to increase again. So it was likely that the new interest rate will be again 25 points higher. And guess what? This is exactly what happened. Now, if there's one thing all kinds of economists agree on, whether they're from the Austrian school or Keynesian school, it is that if an interest rate is increased, the respective currency increases in value. However, as we can see, the Kiwi dollar drops aggressively to the downside instead of going up, despite the central bank increased the interest rate. So this is a case of clear manipulation where on the other side of the trade there are big stops and the degree of boldness of the smart money algos is so high that they simply go for the stops rather than following the economic logic. This is a very clear case where this happened. So the degree of boldness of the smart money algos depends on the dumb money bias. If it's, so to speak, worth it to move the price to some level, to take out stops there, then they will do that. However, if there is no big target and it makes more sense to follow the economic logic, that is the base case. And there's a whole range of different things the smart money algos can do. They can even do fake momentum or house cleaning, where they move the price in both directions and take out stops on both sides. They like to do that, for example, when there are no interest rate changes. As a footnote, you may have come across the multifractal model by Benoit Mandelbrot. It's very interesting because obviously the model is focused on the price behavior, on how the prices actually move. It does not look at what fundamentally drives them. But there are certain phenomena which were pointed out by Mr. Mandelbrot that can be explained by the actual market structure. For example, you have volatility clustering, so the tendency for volatility to be clustered together. There are times of a lot of movement in the market, but then there are times where there's not much movement, such as the so-called 10-hour boxes, where the price goes sideways. There are different reasons why the smart money algos do that. Sometimes they do it because there are stops on both sides, and the algos wait for those to come closer. You may say to yourself, well, I will not follow any indicator, any system. I will simply tape read. I will observe the price, how it moves, and then just do my trades. And this is already incorporated by the smart money algo funds. they do something called hypnosis. So they will rather move the price in a way, especially in the short term, that when you simply look at the price, the human perception will always have the feeling that the price goes in the other direction than it actually does. You can try it out yourself and you will quickly see what I mean. Also, especially when it comes to lower time frames, again, the smart money algos like to create fake momentum. You look at the price and suddenly it seems to go really with a lot of strength into one direction, and suddenly the whole strength is gone and it comes all the way back down again. It doesn't work to taper it these days because the algos incorporate the movement of the price down to the tick level. This picture also shows what's going on every single day. This is another strategy the algos implement, so-called fake momentum, fake resistance, fake support. So we see here that the price draws in a certain support level in the chart. Then you have a breakout, so people think they can sell, and then suddenly it reverses all the way and the thing has become a head fake. Or the other way around, the algos draw in a support level and then people buy and place a stop below this level, and because the stops accumulate there, this fake support gets broken and the algos take out the stops down there. There are other phenomena such as the so-called grail pattern. So after the price moved in one direction and people trade in that direction and place their stops, then suddenly all of that move is taken back and the plateaus are taken out one by one. I also defined a whole range of more complex principles which explains how the price moves, especially in the short term, and it's almost like a dance. For example, if the dumb money traders pull away the stops, the algos will not run behind them but will go in the opposite direction, and if they come closer and the moment is right, then the stop run will take place. It's sometimes almost like a dance between the two. And this explains also the whole dynamic, the whole mechanic behind the manipulation. As explained, there is a tolerance near the price, so the smart money algos allow sometimes the price to go in favor of certain dumb money traders, otherwise the price would never move. But overall, the dumb money always loses. You could even distinguish between different modes of the algos and also these sessions. So most of the time the price is like in a ranging mode, around 80% of the time. Obviously this range is not linear, otherwise you could play ping pong. It's a non-linear range where the price doesn't really go anywhere, but where also stops are taken out on all kinds of levels in both directions. Then you have sessions which are focused on news, so there's an important news item being published soon and stops and orders and positions accumulate on certain levels. And the algos are focused on using this news before, during and after the announcement to actually fight against the dumb money. Then there are sessions which are whipsawy or which are focused on certain stop runs, and there are also higher time frame dynamics as well as option expiry levels that are relevant. So the fascinating thing is that nothing really works consistently. So no matter which approach you take to the market, fundamentally, technically, no matter in which direction you trade, no matter what your strategy is based on, trend following, breakouts, reversals, scalping, etc. In general, if it's a plain vanilla approach, it will not work over time. And secondly, it also has to be stated, there are certain system destroying dynamics. I mean, there are big news moves out of proportion which kick out traders. And there's also no ability for the dumb money, no possibility to actually learn. If you make historical analysis and you, for example, try to analyze how the market reacts to certain news items, there is no consistency, because the truth is that the relevant factor is the dumb money bias. You may have come across the term ludic fallacy in Nassim Taleb's book, The Black Swan, and this is a very good example here. So, on the one hand, people don't realize that they cannot focus anything and they cannot learn anything, but specifically, they even explain to themselves why certain strategies didn't work or why certain analysis failed after the fact. So they may make a forecast on the basis of an analysis, Then it fails, and they may tell themselves, well, you know, maybe I didn't pay attention to, you know, the political situation or to that news item or to this signal. So retrospectively, people explain themselves why things didn't work out, but that actually there is some kind of logic going on. So they are very narrow-minded, they think in terms of their defined world, and they think that they have any ability to forecast, which is completely wrong. So it's indeed a fallacy where people get trapped into, and since there's so many different factors, there's always some kind of explanation you can put together. Oh, okay, I didn't pay attention to the fact that inflation in China changed, or you know that today there was this in the news. But the reality is that this analysis doesn't work in general, and the forecasting doesn't work in general. You do not need to be a conspiracy theorist to believe all this. Everything that was explained is just the market reality. It's pretty Darwinistic and shocking. However, in general, you should be open-minded. Okay, let's talk about statistical approaches to the market and to trading. The idea is that you have different indicators, you combine them, you calibrate them, and then you have some kind of objective system that states when you should enter trades or exit trades, etc. Unfortunately, these things are also very complicated because there are at least 3 specific issues we need to master. On the one hand, we have the so-called repainting of many indicators, we have the lagging of indicators, and the whipsawing. If you would take a look at this chart, you would think, oh, you know what, I quit my job, I found the Holy Grail, yeah, I sell here, I buy here, I sell here, I buy here, I sell, I buy, sell, buy, sell, buy. So this looks like a perfect system with perfect signals, and you know, you just need to follow those arrows and everything is fine. If in life something looks too good to be true, it often is not real, and this is the case here, because in fact what happens is, you get a buy signal here, for example, now the price moves against the signal, and what happens is the signal jumps to the next low. And then in history it looks perfect, but live it doesn't work at all. So the signal jumps from one place to another, and it's not really tradable. The second issue is the so-called lagging. Yeah, many plain vanilla systems, like systems based on moving average crosses, like here. Yeah, I mean the quick MA cross is the slower one. You see this entry is exactly in the wrong place, and it's also very late. You could also have this indicator which is based on arrows like the one before, and those arrows do not appear real time, but they appear, for example, 20 bars later. So the price is already here and suddenly the signal appears. Obviously these are significant lags, and they often make those kind of indicators completely useless. And then we have indicators which do not repaint and they do not lag, but then they tend to have these whipsawing characteristics. So they may give you a lot of signals, a lot of false signals, and these are neither tradable. Now obviously you can think now, okay, what do I combine different indicators? I take, for example, the last one, which doesn't lag and doesn't repaint, and then I just filter all those signals out with some additional indicators, some filter. And yeah, it's a good idea, however, this approach is also not easy. It's complex, because it's easy to over-filter signals where you cut away too much price action, and even the filtering itself sometimes doesn't really improve the signal quality. Like here, you have you know, the red mode, the bearish mode, and then you only take the red signals. So first of all, those good signals here, they are skipped on the other side, and secondly, even those signals in the right color are not guaranteed to be good. However, you can already improve the quality of trading through this kind of filtering. There's another issue. Unfortunately, if there is some kind of price moves, most of the time during that move there will be some quite aggressive counter move in the opposite direction. And first of all, it makes it difficult to trail any price moves. When you try to move the stop along, you will get kicked out and then the moves comes. But secondly, it also destroys a lot of signals because it goes so far the other way, so-called gripping, that it gives you an opposite signal and then the price again retraces. So it's quite difficult to write most of the moves, even though if they exist. So this is a dilemma that needs to be solved. You have repainting indicators, you have lagging indicators, whipsawing indicators, you also have aggressive moves as a result of news, and you also have the filtering issue. However, there are solutions to each of these problems, but they are complex. Even if you figured out a statistical system that looks good, the problem is also the trade implementation. Because the fact is that a human trader who tries to follow the system, he first of all is sometimes quite late and he doesn't follow the signals immediately. And secondly, he also may have emotions. Every human trader has emotions, no matter how nerdy you are. So a computer is just better. A trading robot is better when it comes to the trade execution. Yeah? The computer will simply follow the rules which are predefined, implement the trade, will do the stop management as it is programmed to do, and it doesn't have any kind of interference. So this brings us to the topic of automated trading. Obviously, as we saw recently in the news, computers also have the limitations. I mean, would you sit in an airplane which is flown by a computer? No, you want also human brain to be in the cockpit. Or, you also want a car to have a human driver. Maybe at some point will be at a level in terms of the technological process where all the cars will be self-driving. Yes, there is this development. However, at this point in time, and when it comes to trading, it makes sense to combine the strength of both parts. Yeah? This may be a good example. This is the cockpit of a Boeing from some decades ago, and you see so many indicators, so many analog information, right? And the pilot has to incorporate these, and then you see a modern cockpit where he just has a few displays, and so many tasks are taken over by the machine because it's just better doing so. However, at the end of the day, you still want a human brain sitting here in front of the controls, because there may be emergency cases and other cases where the human decision process, the human brain, is better than a computer. So this is not a question of man versus machine. It is a collaboration between those two components. Because as a matter of fact, the machine is better when it comes to the trade execution. It's faster, it just follows the rules, it does what it's supposed to do. It neither has an 8-hour attention span per day. It can trade 24/7. The human part, on the other hand, is very important for the portfolio level. He needs to decide, okay, which robot is activated or deactivated when, with which leverage. He also develops new systems. So all these kind of things cannot be done by a computer yet, because they require independent thinking. So even if you have a trading system which has some adaptive components or learning components, it can at this point in time not replace a human brain. Just as a footnote, as if things wouldn't be complicated enough when you look at the different kinds of manipulation, technical issues with indicators, etc. This is another trap I would like to warn you about. If you use the later versions of the MT4 platform and you try to use a strategy tester to backtest certain strategies of systems, then unfortunately, if you just use the plain platform, the output will be completely wrong. And the reason for that is that MT4 in the newer version actually simulates tick movements through a genetic algorithm in order to save cache. So what you need to do in order to have representative backtests is, first of all, you need raw tick data, then you need to convert this in the right format, you need to import this into the platform, and then you need to have a software which allows you to use that for the backtest. Only if you do those steps, you can check your strategy, the logic, whether it works, you can check it on historical data, etc. And then you're able to optimize it as well. So at the end you get this output here which shows you the profit factor, the win-loss ratio, maximum drawdown, the average winner, average loser, etc. Here's an example of a strategy I developed. This is a quite active dynamic strategy where there are intra-bar entries and intra-bar exits. The EA tries to trade according to certain principles in a filtered manner and also has dynamic exits. And if you were able to solve all those technical issues presented, to incorporate the realities of the market, you may be able to actually develop a good system, but it's a very complicated, complex process. However, what you could achieve is a very, very nice relationship between profit and drawdown. Like here, this system 99% modeling quality, so this is a tick data test. It's not a genetic simulation. However, you can see that despite this is impressive and the return is impressive, more than 160% in a year for a risk per trade of 1.53%, which is very aggressive. I will explain it later. You should trade those kind of systems with much, much lower leverage. However, I also would like to stress that when you take a close look, there are drawdowns. Every EA, every trading robot, every expert advisor has drawdowns. No strategy always wins. Okay, so you have to acknowledge that. And as you can see here, this period over weeks, it went sideways and then went down. Yeah, so this is a drawdown, and then it went up again. So this is important to understand. However, as explained before, if you have good numbers, such as a good relationship between return and max drawdown, and a good win-loss, a good profit factor, then you may have the possibility of establishing a very nice system. And then those kind of returns are feasible. Even if you divide this by 10, so you only risk 0.153% per trade, which is more appropriate, these returns are still very impressive. They outperform any index or any stock trading by far. However, there are those losing months. Yeah? They cannot be avoided. There are months where the strategy also loses. It's part of the game. However, this is the reason why it's very desirable to have a portfolio of different expert advisors. First of all, there's some diversification between the strategies, similar to the stock portfolio. And secondly, if these are uncorrelated, this is especially good because one strategy may be down while the other one is up. And then those performance graphs merge into one portfolio graph, which benefits from this diversification. But compared to a stock portfolio where you have to accept a multi-year drawdown potentially, the drawdown, if you have short-term strategies, is just a few weeks, which is a big difference. So it's very desirable to have different trading robots, like long-term robots, short-term robots, scalpers, trend followers, etc., to combine them. But each of those components has to be already worked out, which is a very complex process. So when you look at this from the perspective of a high net worth individual or a family office or a company, all of these entities have their portfolios. They have real estate, they have maybe private equity, they have commodities, they have bonds, and one of those satellites may be hedge funds. And if you compare all these kind of satellites in the portfolio in terms of return, volatility, risk, liquidity, etc., hedge funds in general are interesting because they tend to be not correlated to the other satellites. But here you need to again distinguish between different types of hedge funds. When you go for the more popular names, the big funds, it's important to understand that there are certain aspects you have to deal with. Most of these have high or long lockup periods, and also because they are so big, they have several billions under management, they have limitations in terms of return. Most of these have their money in all kinds of markets. Some of these are correlated to the market in general or to indices in one way or another. They are at the same time in different types of stocks, and of course there may be some limitations when it comes to the size of the fund. The alternative is to look at smaller funds who are able to follow those more active strategies, some of which we just showed, and who have the ability to also achieve higher returns in that context. The thing is, obviously, you need to do your homework there as well. You need to look at those kind of funds and also differentiate whether the approach makes sense or not. I hope you enjoyed this presentation. As you can see, the topic of foreign exchange trading and also automated trading is highly complex. I invested many years of my life in figuring all this out. I hope that you do not do any mistakes which are not necessary. If you want to trade, first of all, be very careful which kind of brokers you deal with, as explained. Secondly, understand that your chances of winning in general are very slim. You need to invest a lot of time, a lot of research, a lot of testing, backtesting, forward testing, until you have a chance of making any kind of money. And once you have a profitable strategy, be aware that part of it is also a drawdown. So that's the nature of the game. And once the drawdown occurs, this is a real test. Then you will see whether you really believe also in the logic of your system or not. Of course, no system will work forever. This is the reason why it's desirable to have different ones, a portfolio, and to also change systems at a certain point, add new ones, new strategies, then new things develop as well. Overall, thanks a lot for your time. I wish you all the best. Be careful. Bye.